Okay, let's unpack this.
Welcome to the deep dive.
This past week felt like riding a financial roller coaster blindfolded.
Absolutely.
We had, the highest of highs with some political certainty, followed almost immediately by this steep plunge into market volatility.
And a sudden cooling of what was the hottest sector in tech.
It was a really fascinating blend of policy resolution and financial uncertainty.
So our goal in this deep dive is to synthesize the core insights from this whole volatile mix. We'll look at corporate movements, legislative shifts, and really focus on the connections.
And the implications for you as you try to navigate this rapidly changing economic landscape.
So where should we start?
Let's start where the week really began, with that policy stability.
The government shutdown.
Exactly. President Donald Trump finally signed the funding bill,
Which brought an end to the longest federal government shutdown in U.S. history.
clocking in at 43 days, a record.
The biggest immediate impact, of course, is for the furloughed federal workers.
Over 1 million people.
And they're now expecting their overdue back pay, those famous super checks, probably early next week.
Removing that immediate political risk was a huge relief valve for
Oh, for sure. And you saw that reflected almost immediately in the bond markets.
Treasury yields rose.
Yep. The 10-year yield gained 4 basis points.
And just for listeners, a basis point is 1/100th of a percentage point.
Right. But that little movement, it signaled real investor relief that the political mess was, at least temporarily resolved.
And gold prices, which usually rally on fear, they fell back.
Fell 1%. The stability expectation just took the wind out of its sails.
But that stability didn't translate to, joy across the board in the stock market.
Not at all. The reaction was fascinatingly mixed.
Just after we got that resolution, Thursday delivered a massive pullback.
A huge one. The Dow dropped 1.65%. The S&P 500 fell 1.66%.
And the tech-heavy NASDAQ composite plunged 2.29%.
It was the worst day for all 3 of those indices since October 10th.
So this is where the narrative shifts from relief to a new kind of panic.
The data panic.
The data panic, yeah. Even before the shutdown, the White House was highlighting concerns that key October economic reports might never get released.
Specifically, the jobs report and the consumer price index, the CPI.
So even with the government back open, those reporting delays mean the Fed. It's flying blind.
It is completely flying blind. And the Fed is, by its own admission, data dependent.
So the political risk gets removed, but it's immediately replaced by economic uncertainty risk.
And the market reflected that instantly. We saw expectations for a December rate cut, which were near 63%, just plummet.
Down to between 55 and 60%.
The market is basically saying, if the Fed doesn't have clean data, it's going to be cautious. And caution means fewer or smaller rate cuts.
Which forces that sudden rotation out of high-flying stocks we saw.
Exactly.
Okay, so if the macroeconomy is struggling with the data void, let's look at the companies themselves.
The tech sector.
Specifically where the AI hype train just slammed on the brakes.
And the clearest sign of that reality check has to be Oracle.
Yeah, Oracle's stock has plummeted more than 30% from its high back in September.
It's effectively erased all that excitement that was built around its big push into AI infrastructure and its ties with OpenAI.
And the sources say the core concern isn't the tech itself.
No, it's the financing. It's how they're paying for it all.
They're spending an absolute fortune to compete with the big guys, the hyperscalers.
A fortune. We're talking about building huge new data centers in Texas, New Mexico, Wisconsin.
And buying hundreds of thousands of high-end GPUs from NVIDIA and AMD.
And analysts estimate Oracle plans to fund this by raising a staggering $38 billion in new debt.
Okay, wait. Isn't debt-funded growth pretty standard for these massive projects? Why is Oracle's debt particularly worrisome?
It's the debt load relative to their peers, and just as important, the lower margins on this new business.
So Microsoft, Amazon, Google, they're not doing this.
They're funding their buildouts primarily with cash. They have these massive reserves from their core businesses.
Oracle's taking on huge debt for a brand new, really capital-intensive venture.
Exactly. One analyst, Andrew Pisches, he said he struggles to see an avenue for Oracle's credit trajectory to improve.
Because they're relying so heavily on that big commitment from OpenAI.
A multi-year, $300 billion commitment from a company that is, for all its potential,
A cash-burning startup.
Precisely. And on top of that, the gross margins Oracle gets from renting out these GPUs are way lower than the almost 80% margins they get from their core software business.
So the market is suddenly pricing in the true cost of that debt.
And the impact on actual profitability.
Here's where it gets really interesting.
Right.
That skepticism isn't just about Oracle's balance sheet. It's starting to extend to the entire accounting practices of the AI sector.
And that's thanks to Michael Burry.
The investor from The Big Short.
The very same. He actually just deregistered his hedge fund, Sign Asset Management, and he's intensifying this critique of what he calls aggressive accounting.
And his claim is that the tech giants, Microsoft, Alphabet, Oracle, Meta, are stretching out the depreciation schedules on their hardware.
Yes.
So for the listener, how does slowing down depreciation actually inflate a profit number? Can you break that down?
Sure. Think of depreciation as the cost of using up an asset over time. So normally a server or a GPU, it might be fully used up or expensed over, say, 5 years.
All right.
If a company decides to stretch that lifespan for accounting purposes to 10 years.
Even if the hardware is basically obsolete sooner.
Right. Then they're recognizing half the annual cost. That means their expenses look lower, which makes their reported profits look much, much higher today.
That's a clever. Burry estimates this could understate depreciation by about $176 billion between 2026 and 2028.
He's basically saying the AI boom looks a lot better on paper than it is in underlying cash flow.
And it connects right back to that Oracle story.
It does. If you're borrowing billions for hardware and then you're artificially slowing down how you expense that hardware, you're masking the true financial strain of the build-out.
Okay, moving from those big critiques to a smaller but really smart strategic move.
Apple.
Apple. They made a brilliant maneuver this week to deal with all that antitrust pressure.
They cut their App Store fee from 30% down to 15%.
But there's a catch.
Of course. It's only for developers who join their new Mini Apps Partner Program.
This is classic regulatory judo.
It really is. Apple is complying with the pressure to lower fees, but developers have to agree to use Apple's own software for everything.
Purchases, age verification, all the back-end functions.
So they lower the price, but they maintain absolute control over the ecosystem and the data. Regulators are satisfied, and their business model is basically untouched.
That is Ecosystem Protection 101. And speaking of effective action.
Ah, the Google story.
A quick success story in enforcement. Google announced they disrupted the smishing triad operation.
These were the guys faking texts from EasyPass and the Postal Service.
They used a kit called Lighthouse and hit over 1 million victims in 120 countries.
And Google filed a lawsuit and shut them down within 24 hours. A huge win for consumer protection.
That speed of response is exactly what's needed.
It is.
Let's pivot now to the kind of policy change that affects Main Street, not just Wall Street.
And this one was a shockwave.
An unexpected one tucked into that federal funding bill. A major hemp ban.
This is a really devastating example of how one tiny clause can just destroy a multi-billion-dollar industry overnight.
So the new rule outlaws products with more than 0.4 milligrams of total THC per container.
And it takes effect in 1 year.
That sounds incredibly restrictive. For context, how much THC is in a normal product, like a gummy?
Well, most of the hemp-derived gummies you see sold legally in, non-marijuana states, they contain anywhere from 2.5 to 10 milligrams of THC.
So 0.4 is nothing.
It's essentially a total prohibition on the current market.
So when industry execs say this will wipe out 95% of the $28 billion hemp retail market, they're not exaggerating.
They are not. This one piece of legislation threatens over 300,000 jobs.
And the big consequence, I imagine, is that people who use these products won't just stop.
Of course not. They'll be forced into the unregulated black market to meet that demand. It's a huge potential shift.
Okay, from devastating policy to some positive personal finance news.
Yes, an essential update for retirement planning from the IRS.
The 401k, 403b, and 457 plan deferral limits for 2026 are going up.
The standard contribution limit is rising from $23,500 to $24,500.
And for savers age 50 and older, the catch-up contribution is also rising from $7,500 to $8,000.
It's a much-needed inflation adjustment that really helps long-term savers.
Meanwhile, far away from the stock market headlines, the housing market continues to show deep, quiet stress.
It does. Foreclosure filings rose 19% year over year in October.
And that's the 8th straight month of annual increases.
And completed foreclosures, they jumped 32% year over year.
Now, activity is still below historic highs.
Right, we're not at 2008 levels, but the concentration of the distress is what's key.
You're talking about FHA loans.
Federal Housing Administration loans, they typically help first-time buyers, people with lower down payments. Delinquencies there are running over 11%.
And FHA loans account for 52% of all seriously delinquent loans right now.
It really suggests that the most vulnerable part of the housing market is under intense pressure.
It validates Jim Cramer's blunt assessment. He said, anything connected to housing is just bad until the Fed cuts rates.
The borrowing costs are just keeping that stress cycle locked in.
Let's transition now to corporate giants and global commodities. Disney.
Mixed results. They reported their fiscal Q4 earnings.
Beat on earnings per share, but missed slightly on revenue, and the stock went down about 7%.
It's a classic tale of two Disneys. The linear TV networks, the legacy business, are a huge drag. Operating income there dropped 21%.
But streaming was the bright spot.
Absolutely. Operating income up 39%, helped by price increases, and Disney Plus added 3.8 million subscribers.
And their physical experiences segment, parks, cruises, is still robust.
Very strong. Revenue up 6%, operating income up 13%. They even said cruise bookings are selling out despite adding more ships.
But the big strategic shift here, the one investors need to watch.
They're following Netflix's lead.
They're going to stop reporting streaming subscriber metrics.
It's a big signal to the market. They're saying the subscriber war is over. We are now focused purely on profitability, just like Netflix.
A really decisive move. Okay, finally, let's look at this tectonic shift in the energy debate.
The International Energy Agency, the IEA.
They just walked back their prediction that global oil demand would peak by 2030.
This reversal is massive. The IEA's new forecast suggests oil demand could continue growing all the way through 2050.
Potentially up 13% from 2024 levels.
OPEC immediately welcomed the news, calling it a rendezvous with reality.
So why the dramatic reversal?
The main reasons they cited are a slowdown in the growth of electric vehicle adoption globally.
And rising demand for things like jet fuel and petrochemicals.
So if policies don't change drastically, the timeline for the energy transition just got stretched way, way further into the future.
Okay, one final consumer detail since we're heading into the holidays.
Buy now, pay later.
BNPL. Half of shoppers are planning to use it, but it lacks consumer protections. What were the smarter alternatives our sources mentioned?
Well, the best alternative for interest-free financing is a 0% APR credit card.
You can get 12 to 18 months interest-free, and you get purchase protection and rewards.
Right. Or using the pay over time features on your existing cards. But the simplest route
Is always using your own cash.
maximize your cash flow, cut some short-term budget subscriptions, and park that savings in a high-yield savings account. It's always better than debt.
So what does this all mean? We've covered a dizzying week. It feels like it was characterized by two major conflicts.
On one hand, a marketplace adjusting to high costs and these profound policy shifts, like the hemp ban.
And on the other, the true painful price of building next-gen tech like AI. While markets cool on the tech financing, physical experiences like those Disney cruises remain strong.
The contrast is really stark. You have Wall Street cooling on AI debt. You have widespread consumer stress with half of shoppers leaning on BNPL.
And yet, at the other extreme, ultra-wealthy individuals are driving a huge rebound in the high-end art market.
Yeah, our sources mentioned auction sales expected to top $1.4 billion.
Featuring a $150 million Klimt portrait and, I can't believe I'm saying this, a $13 million solid gold toilet named America.
It's a definition of a two-speed economy. While the average consumer is using credit to buy presents, the top 1% are buying solid gold plumbing fixtures.
So here's your deep dive homework. Given this backdrop of rising foreclosures and consumer debt, what does this extreme divergence between high-end confidence and mainstream financial stress tell you about the current state of the global economy?
What part of the economic story are you missing if you only track the Dow's record highs?